Get a second for everyone to join in. My name is Yishai Dishi. I'm co-president of Ryerson Trading Association, along with Noah Hazlett. Welcome to our first event of 2022. We're really excited. This event is Trading 102. We're going to be covering different asset classes throughout the event. That includes, one of the headlines, cryptocurrencies, REITs, ETFs, commodities, and then different trading indicators later on, such as the RSI, MACD, that kind of thing. Before we begin, just a few announcements about this club. We saw a lot of new faces signed up, a lot of new names. We want to throw up a poll and ask, did you sign up? Were you a pre-existing member? Which means, did you have an account on a ryersontrading.com account prior to signing up? Or you just made one and you're new and this is your first event with us. This will kind of give us an idea of how many new faces we're getting. All right, almost everybody. Okay. Okay, we can end the poll. So about 2/3 are new. Welcome. So welcome to everyone who just joined. Highly recommend checking out our website. We have a lot going on there. We have weekly newsletters that go out every week covering just different news topics. Important about us, who we are, Ryerson Trading Association. We create educational and informative finance events to kind of teach you about the stock market, different elements to it, some tricks about trading, news about trading, and what to look out for. So we have a couple events throughout the semester, and we have one long simulator stock trading event. So if you're completely new to investing and you don't know what you're doing, but you definitely want to get involved because it's cool and there's a lot going on in it, this is a great way to get your feet wet. There are prizes. It's run through Investopedia and it's free. Everyone can join. Everyone starts off with a virtual $100,000. Everyone has 6 weeks to just trade throughout the semester, do whatever trades you like, except for like penny stocks or like something minor like that. And the winner at the end of the semester, or the top 3 winners, gets relatively large Amazon gift cards, up towards $250. So more information will be coming out on that later in the semester. And without further ado, we look forward to enjoying our event. Oh, and one last thing. We know you might have questions, and we encourage questions. We're going to have a long question and answer period at the end. We encourage you to hold back your questions. If you would like, you can also private message your questions to either myself, Marcel Omri in the chat on the side. And yes, thank you. Liam, take it away.
So what we're going to be talking about today, just a quick run through so you guys are familiar. We're just going to do a quick land acknowledgement, which I'm sure you guys are all familiar with. We'll give a quick disclaimer, and then we're going to run right into the content, which today we're going to be talking about asset classes, cryptocurrencies, trading indicators. That should take about 40, so maybe an hour. And then at the end, there's going to be a Kahoot, and we really encourage everybody to join. It shouldn't be too difficult. And the first prize, well, we'll reveal that at the end, but there's going to be prizes for first, second, and third place. We do have a quick survey at the end. We would love if you could fill that out. There will also be a prize for filling that out. So please do stick around for that. And then we'll have our question and answer period.
Spoiler alert, prizes are almost always Amazon gift cards.
To start off, I'm going to be doing the land acknowledgement. So Toronto is in the Dish with One Spoon territory. The Dish with One Spoon is a treaty between the Anishinaabe, Mississaugas, and Haudenosaunee that bound them to share the territory and protect the land. Subsequent Indigenous nations and peoples, Europeans, and all newcomers have been invited into this treaty in the spirit of peace, friendship, and respect. Just a little bit of a disclaimer before we start. The analyses and conclusions of Ryerson Trading Association contained in this presentation are based on publicly available information. RTA recognizes the risk of trading securities and does not advocate the purchase or sale of any security, nor does RTA take any responsibility for any transaction that may have occurred due to our presentations. This presentation and the information contained herein is not a recommendation or solicitation to buy or sell any securities.
Hi, everyone. My name is Anthony. Welcome to our presentation. I'm going to get you guys started off with an introduction to asset classes. Today, we're going to be covering equity, debt, commodities, and currency. So let's start off with equities. So what exactly is equity? Equity is a piece of ownership in a publicly traded firm. And these firms often need financing, and so they reach out to investors like yourself in order to secure this financing in exchange for a piece of the pie, some ownership in their company. And this comes in several forms. The two most common ones are common shares and preferred shares. The main difference between the two being that preferred shares are a little bit safer. They offer higher dividends, but and often more voting rights, and common shares are the shares that you will typically trade on the stock market. So what are the advantages that come with equity? Well, as the company rises in value, the value of your shares will appreciate as well, and you could sell it for a profit. As I mentioned earlier, you can also gain some dividends through which will contribute to your income, as well as voting rights if you care about participating in the decision making in that corporation. Next slide, please. So the next the next asset class that we're going to discuss is debt. So in debt, the most common debt is bonds. And this is, when you think about debt, it's important to think about it like something that's very familiar to you. Think mortgages or credit card loans. Bonds work in a very similar fashion, except for in the case of bonds, you're lending money to a firm like Apple. And in exchange, they pay you interest, which in bond world, they call coupons. And at the end of the term, they pay you back the money that you lent them. And so a couple important things to observe in the bond world is government bonds, primarily the 10-year treasury bill, which is often used as a benchmark for risk-free rates. And the reason why this is important is because this is the benchmark that you use to sort of assess everything else that's on the market. If you have government bonds that are the safest, and then you have a corporate bond, which is a little bit riskier, then you should expect that the return on the corporate bond will be larger than the government bond. And this translates over in the discussion between stocks and bonds as well, because in bond world, there's something called yield, which is essentially the return that a bond will generate. And so when we consider the fact that bonds are typically safer than stocks, if a bond has a very similar return to a stock, well, then the stock obviously becomes less attractive. And so the implications, as we saw last week, for example, is that when yields increased in the bond market, the stock market started plummeting as stocks became less attractive to investors. And so that being said, watching bonds and watching their yields is important to try and determine what's going to happen in the stock market. How are people going to perceive stocks versus bonds at any given moment? Next slide, please. All right. On next, we're going to discuss real estate and REITs. So an REIT is just an investment vehicle for people to invest into real estate. So basically the way that it works is that REIT fund managers take your money and invest it into a bunch of income generating properties, right? Properties that you typically wouldn't be able to afford on your own. And in exchange for your money, they give you a share of this portfolio that they've created. And in this portfolio, all these different properties, whether it be through mortgage payments or rent payments, the fund managers are generating income and they distribute that income to you. And so this is, and typically REITs, one of their biggest advantages is that they offer very high dividend yields. When you compare REITs to say the S&P 500, you'll see that REITs offer a 3% dividend yield on average compared to 1.2% amongst S&P 500 companies. And this is pretty massive. In addition, real estate, as we all know, is typically pretty stable and generally appreciates in value, which makes it generally a pretty safe investment. Next slide, please. Commodities. So commodities are physical assets. Think things like oil, gold, corn, coffee. These are physical assets, unlike something like stocks, which is just a piece of ownership in something like in a sort of, ignore that line of thinking. But the point is, commodities are physical assets. And like bonds, they're very important to track because they could give you a lot of insight into what might be happening in the stock market. Let's take an example like Starbucks. We all know that in the Starbucks' line of business, something like coffee is incredibly important, right? And so they need to buy coffee. And well, you can imagine that if the cost of coffee goes up, well, then Starbucks' costs will go up accordingly. And so when you're trying to evaluate a company like Starbucks, and you want to anticipate whether or not their costs or whether they're going to be as profitable next quarter as they are this quarter, you might want to take a look at coffee, the price of coffee, and see if it's rising. Right now, you'll actually see that coffee is at a 10-year all-time high. And Starbucks has been struggling in terms of controlling their costs as a result. Next slide, please. So the last main asset class that we're going to discuss today is currency. So you guys, I'm sure, are all aware of what currency is. It's a medium of exchange. You take it to the grocery store every day and you pay the sales clerk in order to get your groceries. But there's different types of currencies, and because of that, currencies could actually be traded amongst each other. The two main types of currencies are fixed rate currencies and floating rate currencies. And the best way to understand those is fixed rate currencies are just currencies that are tied to another currency. So for example, if you take the Chinese renminbi, it'll always trade right around $6.38 against the US dollar. I mean, it'll fluctuate slightly, but that will always be the midpoint. However, floating rate currencies like the US dollar and Canadian dollar, when they trade against each other, they're a lot more volatile because their value is determined by the economics of the country. And next slide, please. Finally, we get to ETFs, and this is actually one of my favorite parts of this presentation. ETFs are an amazing product, an amazing financial innovation, which repackages all of the above assets into a more accessible form for investors like yourself. Let's take an example of a stock like Google, right? Google's currently selling for just under $3,000. And if you're a student like me, I don't have the money to invest $3,000 into one individual stock. I want to build myself a diversified portfolio, and like, and you know, $3,000 is a little bit pricey, but I like Google. Google makes a lot of money, and I want to benefit from their growth. And so ETFs offers you a gateway to something like that. If you take an example like the Vanguard ETF that I have on this slide, they hold in their portfolio 11.5% of Google stocks, which is amazing. And you could purchase this ETF for $131. On top of that, if you consider the fact that there are lots of brokerages like Questrade that offer purchases of ETFs with zero commission, it makes this product so invaluable to your asset selection. Because let's say you take all of the ETFs that I have listed on this slide, right? If you're interested in cannabis, for example, there's an ETF for it. If you're interested in tracking the growth of psychedelics, there's an ETF for it. Technology, Bitcoin, ESG stocks, all these different sectors have an ETF that tracks it. And the amazing thing is, if I wanted to buy one of each of these ETFs, I could purchase it for as little as, I think it was $270 when I last calculated it. And that gives you exposure to all of these different markets and gives you a diversified portfolio at the same time, which I personally think is awesome. So that's the end of my section. I'm passing it off now to Nathan. Oh, sorry, my bad. I actually had a question for you guys. So the question is this: given what we've discussed, if bond yields are anticipated to rise, do we expect the stock market to rise or drop? We've sent out a survey to you guys. Please fill it out. Awesome. I see that 80% of you guys got it right. And just so everybody understands, I'll go through the explanation again. So as bond yields rise, that means that the returns that are generated from the safer asset bonds compared to stocks increases. And that makes stocks less attractive than bonds, well, relatively less attractive. And that's why some investors may decide to sell their stocks in favor of bonds, which results in the stock market dropping.
All right, my name is Nathan, and I'll be discussing the topic of cryptocurrencies. So moving on to the first slide, what is crypto? So crypto is a digital and decentralized currency on a blockchain. And a blockchain is basically a digital information system where all transactions and recordings appear on. And as for the decentralized part, decentralized just basically means that it allows the currency to be out of control from the government and authorities. So one of the main purposes for cryptocurrency is to compete against fiat currency. This includes the US dollar, Canadian dollar, and other national currencies. And unlike the Canadian dollar or the US dollar, there is no central authority that manages or maintains the value of the cryptocurrency. Instead, these tasks are really distributed among the users of the internet. Another purpose of crypto is a payment method for a variety of goods and online stores. And really the first crypto coin ever created back in 2011, I believe, was Bitcoin, as many of you guys know. And this was under the alias of Satoshi Nakamoto. And till this day, nobody at all knows the actual figure behind this person. There are some images appearing online, but it turned out to be false. So he actually holds the most Bitcoin from anyone in the world. So that's just a brief overview. And moving on to the second slide on how to trade crypto. So many exchanges offer buying and selling crypto and specific tokens as an investment. They also offer contracts to create longer short positions with leverage. And essentially leverage is basically putting in a deposit and letting the exchange cover the rest of the funds for the trade. And now you might be asking, what's really the difference between the stock market and the crypto market? Well, unlike the stock market where it's open from 9:30 to 4 p.m., the crypto market is actually 24/7. So this allows people in different time zones to also trade. And because of that, there's not really the best time to trade unlike the stock market. And due to all of this, it causes the crypto market to be much more volatile, which also turns out to be much more risk. And heading on to the next slide, how can we trade crypto? So there are many Canadian exchanges that offer the trading and investing in cryptocurrency, such as Coinbase, Binance, even Wealthsimple, crypto.com, and much more. However, due to cryptocurrency being decentralized, there are some regulations Ontario placed, which causes some limitations within each different application. So due to this, of course, always do your research and find out which suits you the best. And when investing in crypto or even trading, it's always recommended to purchase a wallet, which allows you to safely store your crypto just in case if, let's say, an application shuts down or gets hacked. And so what this wallet does, which looks like a USB, a USB on the screen, it turns these coins into private keys, which still allow transactions and also prove the ownership of the crypto token. Moving on to the next slide. Is crypto really a scam or is this the next big thing? So just in 2021, scammers took over $14 billion from crypto. And this is due to a variety of reasons. As many of you guys have seen, probably your favorite influencer was promoting a crypto token on their Instagram story, or even some crypto coins are trend on TikTok. And due to this, a phrase known as pump and dump has been trending a lot. And which essentially it is when your favorite influencer would promote a coin, and right after, and because they promote a coin, they have the most holdings. And once it's at a good price for them, they would sell it, and which would cause the crypto token to go to $0. And it would just basically create an upside down V. And so due to this, also many meme coins were created, as some of you guys may know, Dogecoin or SafeMoon. So what's really legit? How can we find out which ones are the actual investments or assets? So there's several coins that have actual projects and partnerships, and also viewing the website and its white paper. And the white paper of a crypto coin is basically something to search up online, and it shows you the fundamentals and technicals on how the crypto coin was developed and also the team behind it. And usually legit tokens such as Ethereum or even Bitcoin, they all have these white papers to show proof that's an actual coin. And so due to this, it's always smart to do your due diligence whenever making an investment, and also know which crypto coin is best for you, as even Dogecoin, which started off as a meme coin, now is one of the top 5 most valuable crypto coins. And this is due to the push from Elon Musk, where he now allows payments of Dogecoin on the Tesla website. And he's also trying to push the McDonald's CEO to accept Dogecoin as well. So we'll see how that goes. And now moving on to my poll question. If I want to move my Ethereum holdings from my account, will I be charged any extra fees? okay, and 66% of you guys said yes, and 34 said no. So this is just going to go on to a small overview of the next topic in the next slide. And these are actually called gas fees. So these are essentially payments created to basically make up for the energy and time used of Ethereum. And the gas fee amount is actually determined by supply and demand on that time you're trying to deal with the transaction. So if Ethereum has lots of volume during a specific time and you try to make a transaction, the gas fee will be much higher than another moment. And Ethereum is really used more commonly for transactions than Bitcoin, just due to it being much faster than Bitcoin itself.
All right, thank you, Nathan, for that beautiful crypto overview. That is definitely the technology of this era. You know, there was the agricultural revolution, the industrial revolutions, and some may think, you know, crypto is it's going to start the new revolution, because, you know, crypto is nowadays, you know, if you actually look at the utility of crypto, it's more for developers to create their own unique softwares than actually used as an investment vehicle. But as you know, retail investors, we see the volatility of crypto prices, and you know, we are kind of sucked into that world of how to profit from these volatilities. And so I'll take you through some indicators that can help you trade and navigate your way through the crypto markets. Of course, there are a million different indicators in the world you can use. You know, indicators are just basically a fancy word for saying visualized mathematical formula that we can use to trade. Okay, so I'll take you through a couple indicators today. So let's dive into the first one. All right, so the first one we're talking about today is the MACD. This is a very basic fundamental indicator that the trading world uses. This is also known as the moving average convergence divergence. So we're going to stick to the basics here. There's various ways you could use this indicators, but just the basic, we're going to stick to the basics today. So in essence, this indicator uses momentum, uses moving averages to determine momentum of an asset price. Now, momentum is basically, you know, if a price is going up really fast or down really fast, you want to catch that train. You want to catch that train of movement. And well, that's not really the best way to invest. The best place to invest is actually just the beginning of the momentum. Okay, and MACD kind of gives you a direction or estimation on where the beginning of the momentum may be. Okay, so that's basically the essence of it. And I'll take you through a little bit of theory of how these MACD and signal lines are calculated. So a MACD line, which is actually the blue line at the bottom picture there. Okay, this is calculated by subtracting the 12-day EMA and the 26-day EMA. Now, what is an EMA? EMA is an exponential moving average. Now, that's a fancy word. So what is that? So that is basically the average of X amount of price, average of the price of X amount of periods in the past. But the more current prices are given more weight. Okay, that's the exponential moving average. Now, if you want to go dive deeper into that, I encourage to do so. But for our purposes today, we don't need to know what that is. So we're just going to stick to the basics here. Okay, just the MACD line is the blue line. Okay, if you want to stick to that, that is that. Signal line is the EMA of the MACD line. Okay, exponential moving average of the MACD line. Again, if you want to dive deeper into the formula on how to calculate the EMA, you can do so. But for today, we're going to stick to the basics. Histogram, which is the little bars in the middle there going across, that's called the histogram. And that is the difference between the MACD line and the signal line. That is honestly not that useful in our purposes today, but hey, it's good to know some terms, right? So let's go to the next slide and dive into how to actually use this indicator. So two basic rules, okay? Two basic rules. This is how you can use this indicator very profitably. So first one, okay, when two lines, okay, both of the lines, when they are below zero, okay, zero is basically where the histograms are shooting out of. That is the zero line. Okay, so when both of the lines are below zero and the MACD line, which is the blue line, Okay, the MACD line comes above the signal line, which is the orange line. So when the blue line comes above the signal line, you buy there. Okay, you buy right there. And on the sell side, on the other side, when both of the lines are above zero and the MACD line comes below the signal line, then you will sell. Okay, now take a moment to take that in. Maybe you can note it down somewhere if you'd like. And also just to note, this MACD indicator is free on TradingView and Yahoo Finance. So you could definitely have free access to that. So once you're done noting that, I believe that is enough time. So let's move on to the next slide and see some examples on how MACD can be very profitable. So here we can see the bottom, the MACD line is actually the same line we used from the previous slide, right? And the price action is given for you here. So you can see at the very left where the big buy sign, buy text is and the arrows, you can see that the MACD line crosses over the signal line, okay, which is below the zero line. And if you bought right there, right when the MACD told you to, or the MACD crossed it, then you would have been in pretty hefty profit, right? And on the other side, let's take a look at a sell example. You see the sell on the very right side. You can see that the MACD line comes below the signal line, and both the lines are above zero. And if you sold right there, you could have actually had a little bit of profit. Okay, a little bit of profit to the downside. But remember, this is, if you look at the chart overall, this is a bullish, okay, this price is bullish. It's just Apple. Apple was bullish on the past couple, actually several years, to be honest. And so your buy signals are actually going to be stronger than your sell signals, because there's an overall market sentiment that buys are stronger. So your buy signals on any indicator is going to be more biased towards the buy side than the sell. So on the sell, you're going to get a short-term little, here and there, maybe scalping or so, but buy signals are much more stronger. Okay, you can take a look and take in all the visuals going on there in the MACD lines. So I think we can go on to the next slide to show you another nice indicator that you could use to your benefit, which is called the percentage price oscillator. Okay, also known as the PPO, because that's a very big word. PPO is pretty much exactly identical to the MACD. Okay, you even use it the same way. But the only difference is that the MACD calculates the actual difference between the 12-day EMA and the 26-day EMA, whereas the PPO, percentage price oscillator, uses the percentage difference of those EMAs. Okay, that's just a little different. A lot of traders say that PPO is kind of like a more accurate MACD. It's up to you if you want to believe that or not. If you want to do more research on it, dive deeper into it. Whatever works for you and your strategy. The market revolves around you and how you trade. So try both to see what aligns with you, right? And so that's the PPO line. And signal line, again, it's the same definition, but this time it's the EMA calculated from the PPO line instead of the MACD line. Okay, histogram, same difference. Same thing, difference between PPO line and the signal line. Okay, now the next slide, we'll dive into how to actually use this PPO line, which is honestly exactly the same as the MACD. So if you missed whatever we just talked about on how to use the MACD, don't worry, this is your chance to learn it again. So again, right, when the PPO line, okay, PPO line and the signal line, both the lines are below zero, and the PPO line comes above the signal line, or the blue line comes above the orange line, you buy. Okay, on the other hand, when both of the lines are above zero and the blue line comes below the orange line, then you sell. Okay, pretty simple, pretty straightforward. Now let's move on to the next slide to show you some examples. So here we go, right? Now, before we dive into the examples here, notice that this is a price of Bitcoin, and over the last couple months, Bitcoin has been very bearish. So any indicators that you use in any bear trend, you're gonna see that your sell signals are much stronger than your buy signals. Okay, maybe in the buys, you're gonna get a little bit of short scalping opportunities, very short-term opportunities, but in your sells in a bear trend is gonna be much stronger. So looking at a buy on the very left-hand side, you see the blue line comes above the orange line, which means the PPO is coming above the signal line. Then you buy. If you bought right there, you get a little opportunity for profit, a little short-term trading there. But and the second sell, just to the right of the buy there, when both of the lines are above zero and the blue line comes below the signal line or the orange line, you sell. And if you did sell there, you would obviously see a very nifty profit. So again, I guess the conclusion here is find out what the trend is, see what the trend is, determine what the trend is, then use the indicators to get in on that trend. Okay, so let's move on to the next slide for a very interesting topic, a very interesting indicator. This is one of the fundamental indicators that traders use all around the globe. This is the Fibonacci retracement. Okay, this is a very hard concept to even grasp. Fibonacci retracement. A lot of you probably heard of the word Fibonacci or the mathematician Fibonacci. And so people use that to trade because, again, indicators are mathematical formulas put into visual perspective for traders to use. So Fibonacci, being a great mathematician, traders thought, why not use Fibonacci as well? So let's dive into the theory of a little bit of Fibonacci. Fibonacci sequence, many of you probably heard of it, golden ratio 0.618, or the logarithmic spiral. Okay, you'll see this everywhere in nature. You see the universe, there's a little picture, picture of the universe, eye of a tornado, a little snail there, a lizard's tail, a fern. There is a lot of things, right? A lot of things are shaped like this in the universe. And some people say you could also calculate the number of petals using the Fibonacci sequence, or even count the number of branches using the Fibonacci. And so traders thought, if everything in the world can be explained by the Fibonacci sequence, can you use this golden ratio and the Fibonacci in the financial world? Okay, and the answer apparently was yes. Okay, so how do we use this? Okay, so let's dive into how to use this. And so again, it comes down to figuring out what the trend is. Okay, figure out what the trend is, then use the indicator. Okay, and so let's assume that there's a bull trend. Okay, right now the market is in a bull trend. They call it the super bull trend. Every 100 years there's a super bull trend where market just goes up and up and up. But market doesn't go up and up and up. It goes up and then it comes down, and then it goes a little higher than the high, and then it comes down, and then it goes a little bit higher and then comes down. Okay, and that coming down is called retracement. Okay, it has to cool off before it shoots off again. And that retracement is where you want to enter. The end of a retracement is when you want to enter, because that's the best place to enter a trade. Okay, there's a nice little graph or illustration to the right, bottom right. You see the retracement is marked. Okay, the pullback, retracement or a pullback. You wanna enter a trade at the very end of the retracement where the red circles are. Okay, and now how do we know where the red circle is going to be? How do we know when the end of the retracement is? Well, we'll use the Fibonacci levels to determine that. So let's move on to the next slide to see how we can use the Fibonacci retracement. Okay, so in a bullish trend, price will create a series of higher highs and higher lows. That's what a bull trend is. Okay, so what you do, I'll just explain this chart real quick here. HH, higher high. That's the short form for it. HL is a higher low. Okay, so higher high, price creates a higher low, and then price goes up above the higher high, which is, I marked it as second higher high. Okay, so what you do is you take your Fibonacci, which can be found in Yahoo Finance or TradingView. You draw it from the higher low to the higher high. So in this case, you draw it from the higher low, HL, to the second HH. Okay, second higher high. And then you wait. You wait until price comes back to the 6180 or the 7860 level, which are the little purple boxes, rectangles marked for you. And you wait until price comes down there, because that's the retracement. That's most likely the end of the retracement. And then what you want to do is maybe you want to, slap in the MACD. when price comes down to 61.80, or you wanna include the PPO, and when the PPO or the MACD gives you a buy signal within the 61.80 or the 78.60, you want to press that buy button, because that's when you have the highest probability of getting into a trade at the end of a retracement. And of course, if you did employ that method in this case, you would have been pretty good profit. And this actually played out. This is a Moderna chart. So if you were looking at Moderna and using this indicators beginning of or mid 2020, you would have gotten in, at $60, which is pretty good, right? Moderna's at it hit, I think, $300 at highest, or $400. So yeah, that's how you can use the Fibonacci retracement. Another example on the next slide, just to bring this home and drive it home. Okay, so the bottom left is the illustration that we just went through. And then it creates a third higher high, right? The third HH, the third higher high. And then it comes down, it retraces down to a third higher low. And then it goes back up to make a fourth higher high. So what you do, again, that's the way you use Fibonacci, right? You draw from higher low to a higher high. So from third higher low to the fourth higher high. And then you wait for price to come down to 61.80 and 78.60, okay? Trading is a game of patience. So you wait for it to come down, and then maybe use your MACD and PPO again to get a buy signal, and you go in, you buy. And then that's how you buy. And at 120, and price went up and up and up until 400, and then I think we traced after that. Okay, so that's a little bit of how you can use the Fibonacci, very powerful tool in determining the retracements. So I believe we have a poll on the next slide. Okay, I think this is a pretty simple one. Using MACD, should we buy or sell at the indicated zone? The indicated zone is the yellow arrow to the very right, top right of the graph, okay? Should we buy or sell at the indicated zone? Awesome, we will sell. Okay, now why would we sell? Let's move on to the second one. Next slide. So you can see we will sell because, remember the two rules, right? Are both lines above zero? And they are. Second rule, did the MACD line, the blue line, cross below the signal line, the orange line? And it did. Okay, and you would take your short position right there, and and it works out pretty good profit there. So that is it for this section of the presentation. I believe I'm passing it on to Marcel for Kahoot.
So I hope everyone's ready. We're gonna play a fun game of Kahoot now. So the first place prize for the Kahoot is the $50. Second place is $25, and I believe third place is $10. So I just ask everyone, when you're signing up on the Kahoot and entering the game, to use your real names so that we can actually give you the prize. So don't use made up names unless you don't want the prize. Just gonna pull it up. I will be sharing it in 1 second.
Best music ever. Following the Kahoot, everyone is welcome to participate in a Q&A session where you can just really ask our analysts any questions you might have had. A lot of questions we didn't get to fully address in the chat. So you'll be able to bring it up there and just keep the conversation going.
So we have 40 people. Is anyone still trying to get in? I know there's 60 people in the call. Should I wait for 2 more minutes? 1 more minute? Is everyone in? Everyone who wants to be in the game? All right, we're gonna start now. So your first question, true or false? REITs typically have strong capital appreciation and poor dividend payouts. The correct answer is false. A lot of you guys got it wrong. We've got Pura Cash at number 1. Sorry if I mispronounced it.
Intensity.
Hmm?
Go per cash. The intensity.
Rank the following asset classes in terms of riskiness from lowest to highest. Five, 4, 3, 2, 1. The correct order is bonds, preferred shares, and then common shares. Safe rises to the lead. Next question. You notice beef is much more expensive this week. Which asset class would you look at to determine why this might be?
The answers are just flying in. Oh my goodness.
I guess I set too long of a time for this. Everyone's too good at this. Most of you guys got it right. Commodities. Someone else in the lead now. Are you? True or false? Crypto and stocks are traded in the same market. Oh, dang.
You see that just jumped to like 38?
Yeah. Definitely gave way too much time.
Just listen to Kahoo music.
Therapeutic, isn't it? Actually, it kind of raises your stress level. So most people got it right. Correct answer is false.
Good job.
Are you still in the lead? Next question. Which crypto coin seems to be the worst investment?
A lot of crypto nerds in here. A lot of answers fast.
The US dollar. The answer is the US dollar.
So a lot of people got it right. It's the Wakanda Inu. Safe takes back number 1.
What is it? A tight lead.
What is the best way to determine if a crypto coin is legitimate?
You guys even read this quickly.
People just see Elon Musk and they're like, that's it.
That's the answer. Holy right.
Discovering and analyzing its a white paper.
Really thought it was the Elon Musk one.
That's where my heart was at too. Safe still in the lead.
All right, Saif is the man to beat.
What is the golden ratio in investments? The answer is 0.618. Safe is still in the lead.
Very tight leaderboard.
Using the Fibonacci retracement indicator, when is the best time to execute a buy position in a bull market? A lot of you got that right. At the end of a retracement.
All right, people were focusing. It's good to see. I didn't even remember that.
Safe has the highest answer streak of 8.
So you're killing it.
According to the percentage price oscillator, should we buy or sell Bitcoin according to the graph?
You just need to squint a little. Just put your face.
The correct answer is buy.
See who got it. The
Third.
boss in third.
Yeah.
First place, drum roll. I wonder who got it saved. We got some runners.
Congratulations to Saif, Abbas, and I didn't get a chance to see the last name. Oh, Prakash. Feel free to message me in Zoom your emails. And after this event, I'll send you an email and we can talk from there. Now we'd like to move on to the question and answer segment of our event. Liam, if you could pull back up our presentation. Thank you.
Is it up there?
Almost
see it?
loading.
It's coming up.
Oh,
Still loading.
so weird.
In the meantime, I want to address one question. What kind of brokers do you suggest for trading? So Iris, I believe I hope I'm pronouncing that name right. We've actually, Iris, oh, sorry. We've had an event on this and we covered different kinds of brokerages between banks, Wealthsimple, and Questrade. We had a Questrade speaker come on. In general, I'm a big fan of Wealthsimple and Questrade. It depends what you want to do. If you're interested in trading derivatives, so like options, Questrade gives you that ability, and you have a bit more flexibility in terms of like markets on Questrade than you do on Wealthsimple. But if you're interested in just sort of like longer term passive trading, even active trading, and you want zero commission fees, Wealthsimple is definitely the way to go. I think both of those are better than the banks.
Okay, thank you.
Sorry, I also wanted to ask, like, just can you go over the like MACD line? Because like for the last question, like I don't understand where exactly are we meant to buy and sell? Like, because from what I jotted down, it says like we should buy when the blue line, that's the MACD line, is below the orange line. So I just want to clarify that, you know what I'm saying?
Yeah, sure thing. Liam, if you could just go to the example slide of the MACD, that would be very beneficial. It's actually, yeah, that one. Awesome. So, okay, so the way you buy is first, the category you have to tick off is, are both lines below the zero line? Okay, the zero line is basically the line that the histograms come out of, okay, the bars come out of, that's a zero line. So you want to make sure that both of them are below zero. The next thing you want to make sure is that, does the blue line come from below the orange line and intersect the orange line? Okay, it has to come from below and go over the orange line. So right at the intersection, that's when you hit the buy button. Does that make sense?
Oh yeah, perfect.
Awesome.
So we're meant to buy when, just right when the blue line overtakes the orange line.
Yes, exactly.
And when is above zero, right?
For buy, it's below zero, right?
Oh,
But for when you're selling, you want it to be above zero,
okay.
and you want the blue line to come from the top to the bottom of the signal line, of the orange line, and then that's when you sell.
Oh, so you sell when the blue line comes below the orange line. That's when you sell.
Yes, exactly.
And when they're both above the zero, right?
No, when they intersect at the top. So Liam, if you can actually just hover your mouse around the intersection point of just any cell. Yeah, see right there, you see how the blue line comes from the top to the bottom and comes below the signal line. So like when it intersects, that's when you want to sell. Does that make sense? Sorry, who was it again?
Yeah, perfect.
Thanks. Yeah, okay, awesome.
Just before we move on to the next question, there is a feedback survey that we would love for you guys to fill out so we can get a sense of how your experience is and what you think. By filling out the survey and including your email in it, you are entered for a chance to win a $25 gift card if you complete it before February 9th. So I've sent the link in the chat, so please just fill that out for the chance to win money.
Super easy. Easy way to win 25 bucks, 5-minute survey. Gives us feedback on what we can improve on, what you guys would be interested in us covering in the future. Goes a long way. Thank you.
And just before, there's some people that might not want to stay around for the Q&A session, so I'll just mention our next event, Trading 202. So it's going to be March 2nd, and we're going to be talking about these great topics. So we're going to be talking about markets. Why do they work, or how do they work, and why did they exist? NFTs, there's a lot of buzz in the media about NFTs. I'm not that clear on it, so I'm hoping one of our analysts can teach us all about them. And charting, it's one of the things that we've talked about a lot of indicators, but charting is just as important and can teach you, quite a bit as well. So that's what to look forward to at our next event. I don't know if the registration is up yet, but it will be up in the next little while, the next couple of days, I assume, or a couple of weeks. So please do register for that event, and we hope to see you there. It's going to be the same kind of thing. There will be a prized Kahoot as well. So if you didn't win this time, please come out next time and give it another shot. And with that, we'll kind of just spur off to these Q&As here.
I think Usman has his hand up.
Hi, can you hear me?
Yep, we can hear you.
I was just wondering, for the Fibonacci retracement, can you use that for a bearish market too?
Yes, absolutely. So instead of, how we discussed, instead of drawing it from the higher low to the higher high, instead you would draw it from the lower high to the lower low.
Okay. So then you would your buy signal would be when the retracement is at its lowest, right?
So Fibonacci's, in essence, you want to use it. You don't want to use it to execute your positions. Okay, that's not what the Fibonacci is fundamentally for. It's the Fibonacci tells you where most likely the retracement is going to happen. Okay, where most likely the end of the retracement is going to happen. So what you want to do is you mark up that 6180 or the 7860 zone, and you wait until price gets there. And once price does get there, you want to use your other indicators, such as the MACD or the PPO, in smaller time frames, to then for the MACD and PPO to give you a buy signal. So in this case, if you're buying, you wait. When the price comes down to your 6180 level, you wait until MACD gives, the blue line comes above the signal line. And if it does come down, does do that, if it does intersect, you hit that buy button, because that's where you're most likely to win the trade.
So it's more for like a long-term trend you're trying to establish, like in what area your buy signal is, and then once from there you use other indicators
Exactly.
for a more short-term execute position, right?
Yes, yes,
Okay, I
exactly.
see. Okay,
You could
thank you.
the Fibonacci retracement is also fractal. You could use it. There are higher highs and higher lows in the daily time frame. If you go down even deeper, there are also higher highs and higher lows in the 15-minute time frame. You could also use the Fibonacci for that. So it just depends what your strategy is, right? It's kind of addition to your strategy, not a strategy itself.
I
Okay,
see.
hope that
So
makes
you could
sense.
use it for like a short-term trade if you really wanted to, though.
Exactly. Yeah.
Okay, I see. Thank you.
Yeah.
I'm going to just go through a couple questions that I have in the chat here. So for a little bit earlier on, I have one from Kian, closer when we're talking about asset classes. About it says, how come corporate bonds are riskier than a government bond? So basically, in the most simplistic view, what makes a bond or any debt instrument risky is if the person that you lend to is going to pay back or not. So the government is considered, well, good governments are considered extremely unlikely, near zero chance that they won't pay you back. So if you go take a government bond for $10,000 at whatever rate, for however, let's say it's for 1 year, at the end of that year, there's almost no chance that the Canadian government will not be paying you back. But for example, if there's a shady lemonade stand and they want to borrow some money from you, you don't really know what their ability to pay is going to be. So you're going to charge a higher rate. And the fact that they might not be able to pay when it comes due, it creates a riskier asset. So I hope that's clear. Just going through the chat here. Somebody asked if the slides are going to be able to access. We answered that in the chat, but I'll just mention for everybody else, in case you didn't see, we will be posting the presentation, and we should be posting the recording as well on the website. So that should be up by the end of the week. So keep your eye out for that. Canby says, is this for trading daily or mainly for a longer hold trade? It was asked during the middle of the presentation, so I'm not sure exactly which part you were talking about. So if you want to add that question in again. I believe who's going to ask this question. How can we stay in touch with one another? Yishai put the link to our WhatsApp. That's a great way to kind of stay in touch with each other, post announcements in there. Actually, Yishai, maybe
I'll drop it again below. Feel free to join this chat, ask any questions you might have. Keep the conversation alive. We had a question on if we're going to be covering options in a future event. We may. So you saw our itinerary for our second event. Our third event, we plan on really engaging the audience and adhering to what people are interested in learning about. So if that's something you'd be interested in, fill out our survey. If there's something in particular that you'd love to learn more about, you don't really know that much about it, you want to have more practical or applicable an idea on it, drop it in the survey. You can email us as well, either on our social medias or on our website, and we would love to hear this feedback.
Yeah, absolutely. Sijal, I hope, by the way, if I mispronounce anybody's name, I do apologize, but I believe it's Sijal, says, is the MACD useful for more volatile investments, or can it be used for longer term investments as well? Maybe I'll just pass that one on to Roland.
Yep. So like we discussed earlier, it really comes down to time frames. You could use pretty much any indicator on any time frame. Now it is up to you as a trader on what you want to do, what strategy fits you. Trading is all about how your strategy fits your personality. If a strategy works for you, it may not work for anyone else. So to go back to your question, yes, the MACD does work in volatile environments and higher timeframes and lower timeframes. But however, momentum indicators tend to perform poorly when volatility is not present in the market. So you want to use the MACD or any momentum indicators during New York session, pre-New York, if you trade pre-New York, if you have access to that sort of markets, or the London session. But you never want to trade it in, during noon, because there's not much volatility, there's not much momentum. So you're going to get a lot of false signals using the MACD and other momentum indicators.
Perfect. Thanks so much, Roland. And on that, actually, maybe you can answer another question about MACD. It says, if both lines are below zero, but orange line is above the blue, what does that mean?
That just means price is still going down. Don't buy yet.
It's not your entry point.
Yeah.
Somebody asked about if we could re-explain the PPO indicator. I don't want to take up too much time in our Q&A, so I would recommend that you watch the recording that we're going to post and maybe go over the slides. Of course, if you have any questions or if you're still not clear on it, you can send us an email or a message, and we will be happy to explain it to you further with one of our analysts.
I think we're going to have one or two more questions, and then we'll end it off for the night.
If anybody has any questions they want to not put into the chat, but also ask with their camera, I guess, or with their mic, you can feel free to do that as well.
Do you think we are currently in a bear market? Wow, what a question.
What market?
It's hard to tell where the market is immediately going to go. There are some indicators on it. It's easier to get an idea on like certain stocks. We saw like a killing in tech and a lot of growth stocks, and that can be attributed to interest rates going up, the yields changing, and a lot of just changing sentiment about the pandemic. But I'm not going to give a definitive answer. If anyone else is interested in one of the guys.
It's, it is a tough question to answer, and we don't want to say we're in a bear market and you all go short or something like that, and then you lose money. So just want to let you know, anything we say is just our opinion and should not be used.
In general, I think when you are invested in a solid company and there's a dip in the market, you'll only lose if you sell. And like, so if you're holding Facebook and Facebook dropped and PayPal dropped, so these are like some of the biggest companies in the world. I would not say at all start selling your Facebook stock. I would say that's just a buying opportunity. And timing the market can be very difficult at times. What's way better and almost always works is dollar cost averaging, which is, you buy every month a little bit or every week a little bit. And when you have these downtrends, that's when you kind of buy double. And when you have very big uptrends, that's when you sell a little bit. It's called combing the foam or the froth. The little froth, everything's really well. Sell 5, 10%, and then keep buying over time. And that just shows for a much safer and longer term, better returns.
Mm-hmm. Nehemia says, can you use leverage when trading stocks as well? You can, but your bank at our level, well, I don't know what level you are, but if you're a university student, your bank probably will not let you. It's usually for more accredited investors. It's, they're lending out to you, so they're not really likely to do that if they don't think that you will pay back.
I just wanted to add, as for Questrade at least, you can open a margin account. So if you go with that route, yes, you can use leverage. Just be sure not to lose your account, or else you will have to pay it.
Yeah, absolutely.
Yeah, and one thing I'd add, just going back to the bear market comment, I won't comment as to what state we are in right now, but what I will comment on is if you guys want examples of what a bear market looks like, I'd point your attention to the stock market in 2002, in 2008, And even you could look at Bitcoin in 2017. Those are all great examples of bear markets.
Yeah, thanks.
We had a question. Do you think crypto is going to be the future, or will it go to zero? I can't say if it's going to be the future and what that means. I think it's going to be more accepted and used upon later on. But I definitely don't think it's going to go to zero. I think far too many massive institutional investors, Tesla has an over a $1.5 billion stake in Bitcoin. JP Morgan, Goldman Sachs, they put billions of dollars into different coins, Ethereum, Bitcoin. And I don't think they would put something into any security, any investment that would go to zero. So I don't think it's going to go to zero. I think we're going to see this trend of Bitcoin in the long term, have these big upswings and downswings, and that's just going to be the future of it until we find long-term application for it.
Yeah. Safe asks a good question here. How do we determine what time frame we should look for? And I want to say that you're looking at what period for trading, whether it's like a daily or weekly or a monthly view. I would recommend, for the first question, it's a very hard question to answer. It's kind of subjective to what your trading techniques are, what your style is, what your comfort level is. But I would recommend starting off with determining how long you want to take a position for. So if you just have some money laying around that you want to toss into an ETF and you're going to let it sit there for 10 years before you ever do anything with it, then you might want to look at more of a month, like a longer term period, such as a monthly view. If you are doing something if you're doing day trading, obviously you're going to want to look at it almost by the minute, if not on a shorter period than that. If you're looking for an investment for, about a year or so, I would maybe look at a weekly view just to be able to find a good entry point or exit point as well. And I think that's mostly it there. Again, if you do have any questions, you can feel free to message us in WhatsApp or on our socials. Probably the best way would be to send us an email. We would be happy to have an analyst speak with you. And other than that, we hope to see you at our next event on March 2nd. Talking about these great subjects. Please fill out the survey. You'll be entered in to win a $25 gift card. There's literally no easier way to make $25. And beyond that, you'll have your input on what kind of topics we'll talk about at the next events. So thanks again, and we'll see you all.